On this video, we're going to be looking at how the government regulates large firms. It covers aspects both of Theme 1 and Theme 3. So who are the regulators? Well, within the EU, it's the European Competition Commissioner, currently Margaret Vestager. In the UK, since 2014, it's been the Competition and Markets Authority, and there are various industry regulators. For example, the Office of Road and Rail, Ofgem, which regulates the energy markets, Ofwater, Ofcom, communications, telecoms, FCA, the Financial Conduct Authority that regulates the financial industries. Regulators are supposed to act in the interests of the consumer, and sometimes what they try to do is they ask, well, if this wasn't a firm with large market power, what would happen in a free market? And they base their decisions on that. We can get an idea of the problem by looking at the monopoly diagram. Now, had this firm stroke industry been efficient productively, it would be producing a QP. Had we had a fair allocation of resources between consumers and producers, it would be producing at the allocatively efficient level, which is where MC, basically supply, equals AR, which is demand. We would be producing QA units at a price of PA. However, the profit maximising firm will be producing where MC equals MR. So they'll be producing at Q star, which is less than QA. So consumers are going to have a lower quantity. They're going to be selling at a higher price. The yellow area shows the supernormal monopoly profit that the firms will be making, and it will be long-term profit. Now, some of that will be what was consumer surplus that is now producer surplus. So potentially the consumer, remember the regulators are there to protect the consumer, are being ripped off basically. In addition to that, there is a cost to the economy as a whole because we are producing only Q star goods rather than QA. So we're going to have that purple deadweight loss, which is not consumer surplus or producer surplus. So that is the problem that the regulators are trying to deal with. On the spec, it mentions profit regulation. I've got no idea why, because we don't use that in the UK. Occasionally it's used in the US. So that is where there is a physical cap on the amount of profits that a firm can make. So they look at rates of return and whether those rates of return are unacceptably high. So let's say they feel that it is high. They'll set a maximum limit that firms can make, e.g. 15%, and they won't be allowed, or they'll be fined if they make above that. Now, the issues with that are that firms can artificially fiddle the figures effectively. They can raise the capital employed shown on their balance sheets. That would therefore reduce the rate of return, which would reduce the chances of them being affected. I'm not going to say more about that because it isn't used. So what is used are price caps. Now, the idea of a price cap is to set a limit on how much these powerful firms can raise their prices in real terms. So it's how much they can raise their prices compared with the inflation rate. Now, the problem is that there are two inflation rates that are used. Sometimes industries use CPI inflation, which in January 2021 was 0.7%, and sometimes it's RPI inflation, which is 1.4%. For the next few minutes, I'm going to be assuming a CPI inflation rate of 0.7%. So firms in an industry might be given an X, in which case the regulator wants them to cut their price in real terms, or a K, which is where they allow them to increase their price in real terms. So, for example, the Office of Road and Rail might want to impose a real price cut of 0.5% on rail firms. That's a real price cut of 0.5%. Now, if it's linked to CPI inflation, then this X of 0.5 would result in a price rise of 0.2%. That's 0.7 CPI inflation minus the X. So they can raise their prices by 0.2%. What that means is that if a rail ticket costs, say, £100, then they can only raise it by 0.2%, which is 20p. So the maximum price that would be allowed in, say, the next year is £100 and 20p on that particular ticket. So why might they give an X, well, it's pretty obvious. If they feel that that the firms are ripping off the public and making too many profits, and they can say, okay, we can control them by this X. And in a free market, competition would restrict their ability. So if they believe that, and they believe that basically this is a monopoly, like say water, then again they might force the firm to limit how much it can raise prices. Now, sometimes firms are given a K. If they're given a K, it means that the regulator is allowing them to increase their price in real terms. So, for example, the Office of Rail Regulation might want to allow train operating companies, TOCs, to increase real prices by 2%. So they'd set a K of 2. So if CPI inflation is 0.7%, then the maximum that firms are allowed to raise their price by is 0.7 plus 2, or 2.7%. So again, if a rail ticket costs £100, the maximum they can raise their prices by is £2.70. So the maximum price would then be £102.70. So why might a regulator allow firms to actually increase their profits by raising their prices in real terms? Well, potentially the regulator could feel that there's investment needed in this industry and firms must be allowed to free up money to fuel that investment so that in the long run costs can fall. So that's going to be linked to dynamic efficiencies. So the customer might be being ripped off in the short run, but not in the long run. So what happens in practice? Well, the rail regulator currently allows rail firms, TOCs, train operating companies, to increase their prices in real terms by 1%. So they have a K of 1. And it's based on the RPI, not the CPI, inflation rates in July, which was 1.6%. Therefore, in March 2021, they are allowed to increase their price by 1.6%. plus 1, which is 2.6%. In Scotland, it's slightly different because they are not allowed to increase their price in real terms. So presumably, the ORR feel that the rail firms need money to invest. What about the telecoms industry? Well, they currently operate on CPI plus 3.9%, so there's a K of 3.9. Therefore, in March 2021, firms like BT increased their prices by a maximum of 4.5%. That's 0.6% in CPI inflation plus 3.9%. To put it another way, they are raising prices by 7.5 times more than the current inflation rate. I think we're going to need quite a lot of investment for them to justify that. So what are the issues to pick up some of those evaluation marks? Well, remember the regulator is a human being and a regulatory authority is not the market. So they've got to guess the right level of X or K. Now, if they are too harsh with the firms, in other words, the X is too high or the K is too low, then that means that firms will make insufficient profits and some might actually leave the industry, say, stuff this for a game of soldiers, we can't compete at these levels. Or alternatively, they could cut easy things to save costs and maintain their profits that way. Now, the easy things is typically those things that will have an impact in the long term or haven't been spent yet. So, for example, investment on safety, investment in training, investment in infrastructure or trains. Now, that could lead to long-term dynamic inefficiencies. The human example of that is shown on the back of this slide, where you can see a train crash because possibly they did not invest sufficiently in safety, and that led to 3 people losing their lives. That is what I mean in practice by dynamic inefficiencies. What if they're too easy on the firms that they regulate and they set too low an X or too high a K? Now that will mean that firms can increase their prices quite substantially, just like BT did. Well, that would mean that the consumer would continue to be exploited, which leads to static inefficiencies, by which I mean higher prices. And now the industry has got the blessing of a regulator to cover them. So they can say, yeah, we're doing it, but that's because the regulators allowed us to do it. Now, remember that the reason why they might be allowed to do this is to allow the firms to invest, for example, in new broadband or in new trains and dynamic efficiencies. But of course, if they've got higher profits, they could simply pocket it and use it for higher dividends and adopt a profiteering approach. So, for example, when water was denationalised and regulated, remember water is a natural monopoly, they were allowed to increase prices by 3% above inflation. And after that time, the dividends paid to the new CEOs and the pay that was paid to them and the dividends that were paid to shareholders absolutely rocketed. There was not necessarily a lot of actual investment going on, so they were simply pocketing the difference. There's another issue that particularly affects rail, and that is price discrimination, because you cannot control every single price. So they have a limited range of prices that they can adopt. Now, I just looked, because I'm a sado, at one particular line from London to Birmingham over 4 dates: Saturday the 20th of March 2021, Sunday, Monday the March 22nd, and moved on a couple of months to Thursday the 27th of May. Now, on the 27th of May, I discovered that there were 78 trains going from London to Birmingham. We can't control all of those, and they were setting 11 different prices that ranged from £12.80 to £94.40. On top of that, some people would have weekly season tickets, some would have monthly, some would have quarterly, some would have annual, and there'll be an awful lot of rail cards. So a lot of people, families, service people, old people, young people would get money off. So you're probably looking on those trains at about 30, I would have thought, different prices. On the 22nd of March, I discovered 12 different prices before 10:35 in the morning, and it went from a low of £10.30 on the 9:46 to over 9 times that, £94.40 at 7:46 in the morning. Obviously, that's the commuter stuff. There is no way at all that any regulator could control all of that. That's just one line, and there are hundreds of lines in the country over 4 days. So real massive problems there. So the result of this is that the TOCs might have certain prices controlled, but some aren't regulated. So if they're limited on one, they could simply jack up the prices of those that the ORR aren't interested in. So how can we stop this profiteering? Well, we could back up the price caps with quality standards or performance targets. So, for example, the ORR could set standards on, say, the percentage of trains that are cancelled, the percentage of trains that are late, cleanliness on trains, investment in new trains, how they deal with complaints. A little bit like if, say, you are constantly missing classes or late for classes, then that will probably be picked up within your school or college's disciplinary system. For water quality, water hygiene, how they deal with leaks, investment in sewers and pipes, communications, things like broadband coverage, broadband speeds. So what can regulators do? Well, again, think about your example in school or college. What would happen first of all is they'd be given a warning or a final warning, or they could be named and shamed, put on report, that sort of thing, put under special measures. They could be fined, but of course we're looking at a monopoly position, so possibly they could just be passed on to consumers unless we have effective price caps in place. So, for example, there you can see that Govia Thameslink have been fined £5 million over its poor communication with passengers, so that would have been a quality standard. And energy firms have been fined £389 million in the last decade, the equivalent of £100,000 a day for failing to do what the regulator has asked them to do. Ultimately, they could lose their franchise or license to operate. So, for example, Northern Rail lost its franchise after years of problems and underinvestment. So the ORR basically said, okay, sort this out, and they didn't. So eventually the ORR pounced. And similarly, Virgin have lost both of their franchises, their East Coast and their West Coast franchise. The West Coast one was very profitable and they held it for 20 years, but they lost it in 2019. On top of this, regulators can insist on certain things. So, for example, BT have to keep open phone booths both in inner cities and rural areas. There's a rather unkempt one shown there, even though these do not make profits. And similarly, Royal Mail must provide a daily delivery service to all UK postal addresses. Well, if you live in a city, you can see that Royal Mail can make a profit. But often in the country, Postman Pat will have to get in his van and drive miles in order to deliver a single letter. Now that will obviously cost more than the price of the letter, but they are forced to do that by the regulator. Or the regulator, often working with the CMA, can change the underlying market structure to make it more competitive or more contestable. So Ofgem opened up the vertically integrated gas and oil markets. That means that the same people who get the gas and oil out of the sea or land are the people that refine it and then sell it to you via gas or electricity in your houses. And it's very difficult for newcomers to break in. So they changed the rules to allow that, and now there's a lot of competition in that particular market. Similarly, they opened up what's called the last mile for competition. So in your houses, you could get your gas bills from probably about 10 different sources. It's the same gas, it's produced within the same network, but the companies compete on the last mile. In other words, the actual bill that they get, that you get. So if they're able to come up with a better way of billing you, then there's competition that way. And that happened again as a result of the regulator. With telecoms, most of the infrastructure is owned by BT, who also provide services to the final consumer. So what Ofcom with the CMA did was they forced BT to establish BT Openreach, which deals with the infrastructure, as a separate company, and there's a barrier between BT Openreach and the company that you might get your bill from. So though they're both owned by BT, there's a barrier to stop BT Openreach giving their mates within BT an advantage. One of the biggest issues for regulators is they get an awful lot of their information from firms in the industry that they are regulating. Now remember that some of that information could lead to the firm being fined, and so they might be, should we say, economical with the truth. They might limit the truth, and the regulator would often have to depend on that because they haven't got the inside sources or resources. So what these firms might do is they might polish that information up a little to make it look better for them to avoid fines. Now the regulator is supposed to act in the interest of consumers, but sometimes the industry might capture the regulator to speak for themselves. There are various reasons for that. They might have previously been employed in the industry, and so they might sort of automatically be thinking their side. They could be an academic and could be neutral. They get most of their information from the industry, obviously not consumers. They can't talk to tens of thousands of consumers, so they're going to be dependent upon the industry. And finally, of course, it could be just self-interest. When they stop being a regulator, they might want a cushy job where are they an expert in the industry. So they could get a high-paid job, but probably not if they've just spent the previous 4 or 5 years fining the industry. For example, a few years ago, I was listening to the radio, and there were lots and lots and lots of complaints from BBC reporters who verified these complaints that a particular rail firm's trains were overcrowded. Basically, commuters were spending pretty much their entire time sniffing somebody else's armpit or worse. When asked about this, the firm said, well, on average, these people have got quite a lot of space, because what they were doing is they were averaging an overpacked train at peak time with a relatively empty train, say at lunchtime. Well, on average, if we average these out, the people are not overcrowded. Now, when the regulator was asked the same question by the BBC reporter, they simply repeated what the firm had said. So they basically completely swallowed the line. To draw a parallel, imagine that you had 50 people in your standard size classroom, and you complained about it, and your school or college said, well, on average there might be 50 people then, but let's look at it at 8 o'clock in the morning when there's nobody, and let's look at it at 8 o'clock at night when there's nobody. On average there's only 17 people in there, so there's not a problem. Of course there is. The regulator could also be captured by a politician, by the government minister who appointed them. So their job depends upon a good relationship with the government minister. And the government minister is a party politician, so currently the Conservatives are in charge. Now, it's quite possible that, fearing for their own job, they might slightly alter their judgments to tie in with what that politician wants. a politician has captured them, acting in the politician's interest rather than the consumer's interest. So these final depends on points. One of the things it's going to depend upon is the powers of the regulator. If the regulator is toothless, then it really doesn't matter how good they are, they're not going to be able to achieve much. Now, we've seen that regulators have a large amount of powers to fine or remove contracts, that sort of thing. However, the question is how willing they are to use those powers. So obviously, say, if we've got a student who constantly misses classes, then potentially they could be kicked out of college. Now, if those students are basically warned and warned and warned and warned and nothing happens to them ever, then the regulator has that ability, but they don't actually exercise that ability. Therefore, they're pretty toothless. So, for example, a few years ago, the water regulator was being interviewed by the Select Committee, and they were asked, how many warnings on bad water have you issued? And they said, well, we've issued about 24 within the last 2 years. And then the question, and how many fines have you made? No, but we have issued a couple of final warnings. So I imagine that the water firms, basically, they weren't the slightest bit bothered by that regulator. Again, we've looked at whether they're too harsh, too lenient, or just right. It's a Goldilocks type thing. We want them to be just right, and occasionally they won't be. And of course, we also need to look at whose interests are they acting in. We know that they ought to be acting in the interest of consumers. They might be captured by the politicians or the industry. And one final question is regulation needed at all? Regulation does cost resources for firms because they have to comply with it, and for the government. So one aim is to simulate a competitive market. The trouble is that market might already be competitive or contestable, and so there's actually no need for it to be regulated. So effectively, if it is a free market, then it's going to be operating pretty close to QA anyway. Though, of course, it may well be that the threat of regulation is what makes the firms act in a competitive way. That's it, no more.